Mr. Braun, what's up, buddy?
Oh, all kinds of good stuff.
AR, John, what's going on, everybody? As always, everybody's welcome to join via video if they'd like. If not, that's totally cool as well. Today might be on the quicker side, um, but let's hop into it.
What are your guys' thoughts on? Of course, we educate pretty heavy-handed on taxes and tax planning and tax strategies, but sometimes that bleeds over into people wanting to avoid taxes at the expense of their net worth and their balance sheet growth.
Yeah, yeah.
What's the healthy balance? How can we help position tax strategies appropriately to where, yes, we're worried about saving taxes and being tax efficient, but not at the expense of the balance sheet increasing over time.
So it's one of my favorite topics because it gets into in basically behavioral finance and financial psychology. This is going to sound so obvious, and David, I would love to get your take on this as well, because David is an engineer by trade, and education. It's so fascinating that our psychology can start to interfere with the actual math. I literally had a conversation with a client. I'm not going to name the person, and she was phenomenal. But she admitted that for the last 5 years, she's had money in a checking account to the tune of it was like $600,000 in a checking account, making no interest because she didn't want to pay taxes. And this is an educated, smart woman, and she's like admitting this, and it was great because she's admitting this like subconscious battle, and she's like, yeah, she's like, but then I thought about it. I guess like I'm paying taxes if I'm making a profit. So if I optimize for paying no taxes, then I don't make any profit. So I was like, yeah, you'd probably rather keep 80% of something than 100% of nothing. Now, it sounds so obvious, like we always talk about when we surface the conversation, but we very rarely zoom in or double click into some of these decision making patterns, and it can happen to the smartest of us. I mean, there are certain topics that are so inflammatory that just hit on a wound and you just don't have any rational thought around it. Taxes is probably at the top of the list, given that America was founded off of like an objection to taxes. So anyway, David, what is your take on that? Can you relate, or have you seen anything similar from a client's point of view?
Well, yeah, it's I think the words that came to my mind is unfortunately sometimes we often optimize for our comfortableness,
Mm.
Mm.
right? So, like for example, I had it was the decent chunk of money with an old financial advisor just sitting there. It was because
Mm.
it was just a pain in the butt because of where this was held and having to go through stuff, but Shelley helped get that done. And it was a pain in the butt. But I lost a decent amount of money because I didn't want to go either to the effort or didn't want to be a little bit uncomfortable in doing some things. So
Yeah.
part of that being uncomfortable is an unwillingness to, change our mindset or to even be open, right?
Yeah. Well, and David, to your point, right? Yes, the fear of the unknown, and that's understandable, right? It's like, well, I don't know what I don't know, so I know right now that I'm fine, right? Versus if I go down this road, there might be some unknowns that I don't even know about. So now, and I got to take the grandkids to soccer practice, so I don't have time to think about this. Um, when it comes to investing, and that's why, right? Like that's why we're here for everybody. Building wealth takes work.
Yeah.
And we mapped this out not too long ago, where we took one project from one client. There was 78 action items, literally. And by the way, I just stopped writing them out. There's probably 100, but I was like, okay, this proves the point. It's just a ton of like actual work. We always think it's going to be easier than it is. I invested in a rental property not too long ago, and and the contractors told me, they're like, okay, here's the timeline and here's how much it's going to cost. I said, okay, great. You guys are going to owe me a batch of cookies when it takes 3 times as long and it's going to be twice as expensive minimum. And they're like, oh no, it won't be. I was like, 100% you're going to owe me cookies. Well, here we are, 2.5 years later, and they owe me many cookies by now. Um, to bring it down to the investment level, municipal bonds, perfect example. I just had this conversation with a very, very, very wealthy client, and he brought up the topic of municipal bonds. He's like, aren't they a great deal? I said, okay, like, what's the tax equivalent yield on those? And he's like, well, what do you mean? It's like, well, the tax equivalent yield is a calculation to basically help equalize. Okay, if you have an investment over here that's tax benefited, right? You're paying, let's say you're paying no state and federal taxes on it. Okay, great. Well, just because that's the case does not mean it's better than everything else. So, as an example, if you have a municipal bond, I'm making this number up, paying you out a 4% yield, completely tax free, what some people will hear is like, oh, tax free. I would owe no taxes. Well, would you take that over a 20% taxable investment? I'm making it extreme for a reason. The answer would and should be no, because at a certain point, the tax benefit, right, is downgraded by the net after tax proceeds of an alternative investment. Colin, what's your take?
So I actually think business owners struggle with this quite a bit.
Mm.
Whereas most of the time, I actually really, really enjoy working with business owners because they're so comfortable delegating problems to other people that after they get a sufficient amount of evidence and information, it's just like decisions made, go run with it. When it comes to taxes, it's probably flavored by, the heavy checks that they have to write every year, out of their business is my guess. Matter of fact, I have to go do that literally after this call. So I'm personally not really looking forward to it. But that said, I've noticed that taxes is a boogeyman for everybody, but business owners in particular, I have been involved in conversations where they want to do something at the detriment of the business to lower taxes. And that to me,
Yep.
um, is we are just misaligning, right, the priorities of the financial plan. So we don't have to spend a ton of time on this, but it's certainly a pattern that I think all three of us would admit we have seen over and over again, where taxes somehow leapfrog like every other objective or goal in the financial plan. And
Oh yeah.
now all of a sudden, Dave, I loved your comment. Like we're optimizing for what's comfortable, right? Not what's actually optimal. Um, it is comfortable not to write checks for taxes, but the only reason that you're doing it is because you have proceeds on the other end of that, right? So maybe it's just a PSA of like a quick public service announcement. Make sure that you're prioritizing the correct things in your financial plan so that you're not doing something that sounds good, right, and feels comfortable, but it's actually at the detriment of your long-term success.
Yeah, and now I'm really excited about this topic because um, favorite subtopic under this topic is anybody running their numbers. One of the things you want to consider is inflation adjusted post-tax returns, right? Because sometimes even when I say, "Hey, what are your net returns?" people are not factoring in inflation. So let's take a peek. It's a graph time, or what do they call it? Chart time. And David, I'm going to pick on you some more if that's okay, because I know you're willing to play ball. Let me show you guys this graph, and let's see. David Braun is very intelligent in general and knows a lot about finance.
In
Um,
general.
and he's 100 and he's 100% going to get this right.
Yeah,
So,
right.
David, we've got cumulative after-tax dollar real, which means inflation adjusted gain of $1 invested in the S&P 500 in 1924 to all the way through 2024, right? If you invested that dollar in stocks, essentially, right, you would have $488.25. Again, that's after tax and after inflation. If you were to take that same dollar and invested instead inside of 10-year treasury bonds, because everybody knows that everybody says like, oh, that's the safe route. After tax and after inflation, how much do you think you would have?
How about $1.50?
Thank you for guessing. Unfortunately, it's massively wrong. It's 7 cents. Um,
Hey, I was like in the ballpark.
yeah, you're
Yeah,
super
that
close. Yeah,
that actually
yeah.
was a good guess.
And it's a great guess.
Yeah.
Um, so this is the macro data that you want to understand, right? And if we make taxes the boogeyman, then you never get to be able to make an objective, data-driven decision. Versus if we just show a family this saying, hey, time out. Before you do that long-term strategy, let's actually see what it's produced in the past. But if you're not taking into consideration taxes and inflation, then you are doing your family a disservice. We're not saying that bonds don't have a place in a family's portfolio, but to not know the data and how it actually impacts your family, net of all of those things we talked about before, that is you're not acting properly as a financial leader. Colin, would you agree?
Totally. The risk conversation in all of finance is just not to the level that it doesn't go to the level that it needs to go.
Yeah.
It's an outdated model at this point, right? The 60/40 portfolio, or, conservative, invest in bonds or the likes, the equivalents. The updating that needs to take place to wash out the conventional wisdom there, with actual education, right? There is no incentive for us to push stocks over bonds, right? From any standpoint, there is just a responsibility to the people that we serve to appropriately position them inside the portfolio. The entire risk curve needs re-educated upon, at least in a general setting, because I'm starting to get to the point where the one-liners, like the general, just kind of like, oh, stocks are risky, bonds are safe. It is far more dangerous and like impactfully hurtful than it is beneficial at this point. It has people sleepwalking into into a financial landscape that I just don't think has ever really been taught to them, or they've been educated on, to their family's detriment, and really risking what should be a prosperous retirement, and turning it into one that actually might not work out. Right. So
Right.
yeah, that the entire risk conversation really needs updated and walk through in much more nuance so that we start to appropriately calibrate risk when we're discussing it in a financial planning setting.
I completely agree. I mean, the one of the challenges is we've heard it from teaching so many students in class, right? It's like, well, why are we hearing this from elsewhere? And the reality is the data is out there. Whether or not you're seeking it is a different story. So a lot of this is you might just be in echo chambers that are just parroting the same things that you've historically heard, and nobody's like actually doing research on it. So as an example, the Wall Street Journal, I'll show you here, wrote an article about this. I think this was in 2023. Says the trusted 60/40 investing strategy had just hit its worst year in generations. Higher interest rates and inflation are upending millions of Americans' retirement planning. Wall Street's boilerplate mix of stocks and bonds isn't cutting it anymore. That, from my recollection, that article was written in 2023. Now, whether or not you stumbled on that article, if you haven't frequented Wall Street Journal articles in quite some time, the data is out there. It's just not very popular. So that's the real challenge. As Colin tells during our classes, like, we have known for a long time that the food pyramid is outdated, right? Now, whether or not that gets updated in the literature in a convenient way, it's like turning around the Titanic. It takes a while for everything to cleanse itself out. All right, so now if if we look at this and we say, okay, well, what's the alternative? Let's say the alternative in this particular case is buying companies that produce things and they sell that production for a good profit margin, and then they share some of that profit with their investors via dividend. We've looked at Costco before, right? The famous example I like to use, and disclaimer, I'm not recommending Costco. This is just a simple thought exercise. David, if you don't mind, I'm going to pick on you again. Costco makes 200 in 2024, I think $254 billion in revenue. Now, the hard part about this is the human brain is not exactly optimized for understanding magnitude and exponential math. It's just not. It's very hard for people to grasp the magnitude of very large things. So to put this in perspective, how much is $1 million, David, if you had to guess, if we were to measure dollars in seconds, how many days would $1 million be? Right? 1 million seconds. What'd your gut tell you? You're going to be wrong, and that's
So
okay.
ask me that question again. Relate it to if, well, like, what's the timeline? Is a whole year like $1 trillion or
No,
what?
no, no. So we'll get to that in a second. So if you were measuring dollars in seconds and you had $1 million, so aka 1 million seconds, how
Oh,
many
okay.
days would 1 million seconds be?
I don't know. You'd have to divide that by 24, 60, 60, whatever that is. I don't know. Off the top of my head, that's 3,672.
Everybody is witnessing an
Probably.
engineer in the wild right now.
I don't know,
Yeah.
maybe it's like 100 days or something like
Okay.
that.
Thank you for
Not
guessing. So
not a
it's
horrible
11
guess
days.
again.
Yeah,
11
that's a
days.
really
Okay.
good, that's a really
So,
good guess. Now, here's the real question, right? So 11 days is 1 million seconds. So $1 million, right? 11 days. How many days is $1 billion if it's measured in seconds?
well, that's like, what is it? Million, a bill, 1,000. So 1,000 times, what was that? 11, you said?
Uh-huh.
Yeah, that's whatever that is, 11,000
Yeah.
seconds.
Uh,
All right, 11,000 days.
yeah. So the answer is 31 years,
Yeah, okay.
right? Isn't
Yeah.
that crazy? Like people would never think. So 11 days is 1 million seconds. 31 years is 1 billion seconds. Now, I got this massively wrong myself. Like it's again, it's just the architecture of the human brain is not built to understand such magnitude. So, to put this in perspective, Costco made in 2024 $254 billion in revenue, right? That is $30 million an hour. It's like $29.05 million an hour, right? Instead of just looking at our phone and saying, is Costco up or down today, right? Remember that magnitude. They have over 950 locations selling $254 billion worth of stuff each year. And it's very likely going to keep on growing from there. So call me crazy, but would I prefer that for a long-term investment versus a 10-year treasury bond that's going to pay me pennies on that dollar and not increase its revenue at all, et cetera. So to me, that's an easy decision. Plus, when we add in the conversation, and we'll probably get some eye rolls from the audience here because I bring this word up so many times, which is dividends. Um, Again, it's concept versus magnitude. Probably all of you on this call right now understand that we're big fans of dividend production, because that's, you're getting cash flow while you're owning an asset rather than just like hoping it goes up in price and selling it at the right time. Well, again, David Braun, if you don't mind, sorry, I'm feeling a little spicy today, putting you on the hot seat all the time. Um, if we look at this, it's okay. We just outlined the case for bonds and what they pay off and their returns over time, et cetera. Well, if we look at something like this, and let's say the S&P 500, um, with dividends reinvested and without dividends reinvested. So if you look down here, the gray line down here, right? If you were to invest $10,000 in 1960 to the year 2023, and you did not reinvest the dividends, your account value would be $796,000, right? Now, somebody like David would say, well, hey, but the dividend's only, 2 to 4% on any given year of the price of that particular holding. How much more really could my account value have been over that period of time if I just would have reinvested that 2 to 3%, 2 to 4%, because it's such a small percentage? Well, yield can be misleading because there's a numerator and a denominator. One of the things we want to think of is something called yield from purchase, right? So how much cash flow am I getting from the original purchase that I put in my money? And I'm reinvesting every single quarter and buying more shares, and then those shares are going to pay out more dividends most likely the next quarter and so on. So you kind of get this like multiplicative compounding effect with your baseline shares. So David, you were close with the 11 days. You were even closer with the 31 years. What do you think if you would have reinvested those dividends instead of not reinvesting them from the period of 1960 to 2023, $10,000 original investment? What do you think the account value would have been?
So you're talking about the blue graph, right?
Yes, exactly. That I put that gray box over.
Yeah, I'd guess it probably around 4 million.
Oh,
Great
close
guess.
again. 5.1 million.
Well, I mean, you got to ask it and not give me the hint because I knew it couldn't be more than 6 million because of the.
Yeah, yeah.
Yeah, 100%. Yeah. So it's just, and again, Colin said it spot on. We don't have a horse in the race of any particular asset. We're licensed across all planes. We can recommend whatever we want to recommend, but to not present the data, right, is not fair to the families that we serve. And hey, if this data ever reverses, we'll tell you the opposite. So as an example, in the early 80s, you early to mid 80s, you get CDs for 15%. Heck yeah, let's get some CDs, right? But those are extreme circumstances, and our recommendations would change in those circumstances. But today's not that day. Colin, would you have anything else to this, bud?
Well, that actually happened in a more recent way, right? We were not talking about a medium-term portfolio for you guys 5 years ago,
Yeah,
right? When interest rates were truly on the floor, there was really no strong argument to have multiple years of your expenses in cash equivalents like treasury bills or municipal bonds or corporate papers or anything else, right? So at the time, the recommendation was 1 to 2 years cash, everything else in a strong fundamental productive asset portfolio that had a strong yield from dividends, right? Because the yield that we received from the dividends was higher than the interest rate on a CD or a bond or a treasury bill, et cetera, right? So we actually have flipped course over the past handful of years because there was a true economic condition that changed our philosophy. Interest rates rose closer to historical norms. They've slightly revised downward since then, but if you can get 4 to 6%, 5 to 7% of interest from a safe investment like a treasury bill or a bond, et cetera, quote unquote safe, it does have its place. So please don't mistake this conversation for, we're just thumping once again for, dividend producing assets. That's not always the case, particularly when we start to get into the minutia and talk about, hey, goals and time horizons and where it fits in directly in your life. So,
yeah.
yep.
Yeah, now to add to this, you guys, maybe some of you have seen the recent headlines given the government shutdown. So let's hop into that. Um, you are now likely, if you haven't seen already, the topic of gold to come up. Because when something starts to, right, like especially when we get the government involved and you start to get into like Armageddon type of scenarios, gold is a very popular retreat topic for people to go in. To that, I will reference Warren Buffett. You may have heard of him. He's a really good investor. He's talked a lot about this topic, and I'm going to bring up his 2011 annual shareholder discussion here. So we are going into the topic of gold, and to help you remember this, Warren Buffett phrases this as the gold cube problem. So I will bring up his letter here. So if you see here, so Buffett on gold as of this time, which was again, this was 2011, he wants you to picture, okay, if you bought all of the gold in the world, right, at the time of 2011, he said today the world's gold stock would be about 170,000 metric tons. Oh, sorry, let me get back to that. Okay, uh, it would form a cube of about 68 feet per side, right? Um, at that time, $1,750 per ounce. Gold's prices are right this. It's valued. Its total value would be about $9.6 trillion, right? Call this cube pile A. Now let's create a pile B costing an equal amount. For that, we could buy all of the US cropland, roughly 400 million acres, with the output of about $200 billion in annual revenue, plus 16 Exxon Mobil's, which would be the world's most profitable company at the time, one of them earning about $40 billion annually. Oh, no, sorry. The company earning $40 billion annually. After these purchases, we would have about $1 trillion left over for walking around money, right? So this is in pile B. No sense feeling strapped after buying this buying binge. So that's Warren Buffett being funny. Can you imagine an investor with $9.6 trillion selecting pile A over pile B? Right. So put yourself in that shoes. Would you rather buy a big block of a metal that doesn't produce any revenue, produces nothing, or all of the cropland of the United States plus 16 Exxon Mobils plus having $1 trillion to be put in your back pocket. So down here it says beyond the staggering valuation given to the existing stockpile of gold, current prices make today's annual production of gold command about $160 billion, right? Whether jewelry and industrial users, frightened individuals, or speculators must continually absorb this additional supply to merely maintain an equilibrium at present prices. Which, by the way, pause here real quick. A lot of people don't consider that they think that gold's supply is fixed. That is not true. The supply is increasing over time, right? Mining, etc. Now, a century from now, the $400 million of, 400 million acres of farmland will have produced staggering amounts of corn, wheat, cotton, and other crops, and will continue to produce that valuable bounty, whatever the currency may be. ExxonMobil will probably have delivered trillions of dollars of dividends to its owners and also hold assets worth many trillions. And remember, you get 16 Exxons. The 170,000 tons of gold will be unchanged in size and still incapable of producing anything. You can fondle the cube if you want, but it will not respond. Admittedly, when people by a century from now are fearful, it's likely many will still rush to gold. I'm confident, however, that the $9.6 trillion current valuation of Pile A will compound over the century at a rate far inferior to that achieved by Pile B. Colin, what's your take?
Yeah, just brilliant wisdom once again. Does not surprise me that there's a rush to gold with now the talk being around the national debt. Will we be the reserve currency, etc.? Oftentimes I think people want to make it sexier than it needs to be, and that's where like some of the itch comes from. Warren Buffett has executed the fundamentals better than any investor ever, and if it's good enough for him, right, it really should be good enough for us. He has he's been a prophet of just productive asset investing over a long time and the compounding nature of it. Matter of fact, Joel and I were having a discussion about Jim Simons right before we got on the roundtable, right? Talking about his cumulative return in his core fund of like 66% over 37 years or whatever it was. Even with those rates of return, he never sniffed the net worth of Warren Buffett, right? Because Buffett hit a critical mass of cash flow that returned on his investment in many instances more in any one given year than he initially invested in the company or in the business that he was purchasing, etc. There is nothing that's going to trump cash flow investing for as long as we live. I think back 100 years ago and what hasn't changed from the investment landscape through today. I believe in 100 years' time, if we were to be fortunate enough to be alive, we would still be thumping the same philosophy simply because it is king, right, in the investment world. And Warren Buffett is the poster child for it, right? If there were a better strategy, somebody else would have his throne, but they currently don't, and for good reason. You'll hear a podcast, you'll hear a webinar, you'll hear all of these people talking about how Warren Buffett has lost his touch and their returns are better and their investment philosophy and he's outdated, et cetera, et cetera. Why is he sitting on $1 trillion of cash and nobody else is, right? Ultimately, he doesn't have to sit here and joust with anybody. The results very clearly and loudly speak for themselves.
Right. And also we want investors not to be confused by price fluctuation. There's all sorts of things that fluctuate in price. And if gold's fluctuating in price right now, that's okay. That doesn't make it a good investment. Right. So David, I'm gonna put you on the spot again. We're gonna have to make you a regular part of this show, buddy.
Welcome to
Tell
the
me,
David Braun show.
yeah. David, tell me, what do you think the market right now for duct taped bananas is to a wall?
Oh, are you
Right?
talking about this one painting or something like that?
No, well, so this is an art piece, right? It's
Yeah,
literally a banana duct taped to a wall.
I heard about this. Oh my gosh.
Yeah. What do you remember what the price was that this piece of air quotes art sold for?
Wasn't it like 500,000 or a million or some crazy
Look at
number?
this. According to
6.2, yeah.
CNN, $6.24 million. Right. So now the banana market looks real good at that point in time. It's like, oh man, this thing, the bananas, that's the way to go. It's like, or is this an anomaly? Or again, oh, there's all these things that can fluctuate in price and people get attracted to that. But the core is like, does it produce value? Does it produce cash flow? And to what degree, as Warren Buffett states, how much cash are you going to get? When are you going to get it? How sure are you? Right? Those three questions. And that third question's a real stinker, right? How sure are you that you can get more than $6.24 million for that banana 5 years from now? Or you better be pretty dang sure if you're going to purchase that thing. Which the funny thing is, I think that artist like came back and said, I purchased the banana like an hour before in New York for like 75 cents. That's a pretty good return. Whether or not we can replicate that, the real question is, can you put a banana in your Roth IRA? That's what I really want to get to the bottom of.
Well, we should ask Peter Thiel.
Yeah,
Yeah.
yeah. Final piece here. Colin had this great graph on energy prices. Again, just to go into inflation and how much of a stinker that could really be. If you live in California, you might want to close your eyes for this one. So let's look at it. U.S. electricity price increases, percent increase in residential electricity prices from 2020. Colin, walk us through your observation here, bud.
Yeah, I felt it anecdotally, just looking at my energy bills. But to see some of the percentage increase from just a handful of years ago, right, it just was pretty eye-opening. Certainly, California always leading the way. So thank you guys for that. But Ohio, I mean, was no slouch, man. To see
Yeah.
a 40+% increase in energy prices in a 5-year span. Yeah, I'll admit I haven't researched this, year by year for decades. But I gotta imagine that this is a clear outlier with regards to energy prices. The interesting part about this, and it's not reflected on the graph, actually producing the energy is cheaper than it's ever been, right? But the demand, and therefore like getting the energy out, is really what has caused the increase of consumption. So
Mm,
we have a lot of work to do as a country from an infrastructural standpoint to help lower these prices. We are better today at producing energy than we've ever been historically, but increased demands, AI, the actual transportation of the energy, et cetera, is all increasing as well. And that's why our utility bills have reflected what we're looking at on this chart, right? So I also want to rope this briefly back into the conversation that we were having a few minutes ago. If you had a 50% increase in your energy bill, the clean, easy, simple, low cost, productive asset portfolio has outpaced it, probably $2 to one, somewhere in that ballpark over the past five or so years. Your CD and your bond portfolio has certainly not kept up to pace, right, with the energy inflation, right? So again, please contextualize this. Do not think that I'm saying CDs, bonds, treasury bills are bad. However, when you want them to compete in the world of inflation, they are going to get decimated, and they're not structurally designed to keep up with the cost of living, right? They are simply giving you an interest rate relative to what the interest rate environment is at that time. If your personal inflation increases over and above the rate of your CD at the bank, your banker will not call you up and adjust that yield, right? It will not adjust that interest rate for you, right? So this is where it actually hits your wallet of taking advice of saying, hey, CDs or treasury bills or bonds are safe. Well, not when we actually go to purchase goods and services in the real world, right? Your
yep.
dollars would have been decimated over the past 5 years when we relate them to energy prices. And we all know that it doesn't stop there, right? It was true at the grocery store. It was true at plenty of other areas in our life. But I thought that graph was a pretty good representation of some of the brunt of inflation that we've all felt over the past handful of years.
Yeah, well, I mean, take what we say in our classes, right? Personal inflation can be massively different than general CPI inflation. Yet in all retirement programs across the country, the projections are usually built off of general inflation. So if we just cherry pick, this one genre of expense, which is energy, look at how wide the range is. California, 63.9% increase since 2020 versus over here, somehow these guys in Nevada have figured out how to get 0.7%. That is an enormous range
Do we know
just
the
crossing
reason,
state borders.
Colin?
Yeah, it was fascinating to me. That was one of my takeaways. I don't know specifically. I wonder if it has to do with their grid must be up to. I don't know. Let's look into that because that's at least interesting
It'd
to
be
me.
interesting to find out why it's so
Yeah.
different.
I
For
wouldn't be
the rest of
shocked.
the
Just a
world.
hypothesis. As you drive into Vegas, right? We've all probably experienced. You just see, football fields worth
Yeah.
of solar panels.
Solar.
You know,
Yeah.
um,
Yeah.
so and it's sunny there basically all year round. So that I wouldn't be shocked if that's a needle mover for that. But
Mhm.
the main point is like, look how if we just zoom in on one metric of inflation, how wide the spectrum can be. So you have to factor that into your personal financial plan. All right, Colin, any final words of wisdom?
Go ahead, Colin.
Well, it was Joel's birthday yesterday. He is my father.
Yeah.
He turned 65 years old, so now he's very familiar with silver sneakers and Medicare. Um, but I'd just like to thank him publicly for, being the rock of our family, for turning the trajectory around and for being, not only a great dad, but a great business partner and a great leader. So there is yeah, happy birthday.
Thank you, Dave. Yeah.
Happy birthday, buddy. Thank you all very much. If you need us in the meantime, just reach out. It's great to see you guys, and we'll see you next month.